Welcome to the Deep Dive. Today, we're tackling a really ambitious question. Could we actually see a brand new stock exchange pop up within the European Union? You've shared this incredibly detailed analysis navigating the labyrinth, and it's packed.
It is.
Our goal today is to kind of cut through all that complexity, pull out the key insights, and really understand what it would take for a new player to actually succeed in, such an established field.
Yeah, it's a fascinating thought, isn't it? Especially when you look at the giants already dominating the space. The analysis really does lay out the current landscape quite meticulously.
Right.
So we'll explore, why anyone would even think about doing this, the really significant obstacles they'd face, and the kind of strategic thinking needed to even have a remote shot.
Okay, so let's start unpacking this by looking at those giants you mentioned. The report paints a very clear picture of who dominates and, frankly, their sheer scale. First one, Euronext. A proper pan-European powerhouse, right?
Yeah.
Operating in Amsterdam, Brussels, Dublin, Lisbon, Milan, Oslo, Paris.
Yeah, all over.
And the numbers are just staggering. First half of 2024, 53 new equity listings, raising almost 4 billion euros.
That's significant capital.
Over 1,800 issuers, a market cap of 6 trillion euros.
Yeah.
And, revenue, EBITDA, both in the billions. Plus, they're consolidating post-trade services, too.
Right.
The scale alone, it just highlights that key insight.
Right.
Any new exchange starts way, way behind in terms of reach, relationships, everything.
Exactly. And, connecting this to the bigger picture, Euronext's whole strategy, operating across all these national markets, it gives them this huge advantage. It's the network effect, right?
Yeah.
The more issuers and investors they attract, the more attractive it becomes for others. It's a powerful cycle. And their move to consolidate post-trade, the plumbing behind the scenes, clearing settlement that just strengthens their whole package and makes things more efficient for them.
Okay, then we've got Deutsche Börse Group. That's Frankfurt Stock Exchange, Extra, and Eurex for derivatives.
Major German play.
Their 2024 revenues and EBITDA are also huge, multi-billion euros. Extra's average order book volume, 1.3 trillion euros.
Wow.
But interestingly, Germany itself only had, 6 IPOs in 2024, and a lot of the public offers were actually aimed at delisting.
Yeah, that is interesting.
That difference kind of offers a key insight, doesn't it? Maybe a pan-European approach, like Euronext's, resonates more with companies wanting broader investor access than just focusing on one country, at least in some places.
It does seem that way. And, that focus on delistings in Germany might also hint at maybe a trend towards consolidation or perhaps companies shifting towards private markets instead.
Good point.
The contrast with Euronext's IPO numbers certainly suggests there could be different market dynamics or, different issuer preferences at play.
Right. Okay, and then there's NASDAQ Nordic and Baltic. That covers Copenhagen, Stockholm, Helsinki, Iceland, the Baltics.
Yeah, big regional footprint.
Daily average share trading value, nearly 3 billion euros. And they had 46 new listings in 2024. They're also a tech provider, which is an interesting angle, selling the picks and shovels as well as running the mine, so to speak.
Indeed. That dual role, exchange operator and tech provider, gives NASDAQ a pretty unique perspective and potential synergies, too.
Yeah.
Their strong presence up north really highlights how important these regional hubs are within the bigger European picture.
And we can't forget Swiss Exchange. Okay, not EU, but still a major player. 4th largest in Europe by some measures.
Definitely significant.
And their group operating income is substantial. Plus, they now own BME, the Spanish exchanges,
Right.
which itself has a market cap over 1 trillion euros and adds a lot to SIX Group's bottom line.
Yeah, and that just underlines the consolidation trend we've already kind of touched on. 6X buying BME shows how strategic it is to spread your geographical reach and diversify revenues in this game.
And then Warsaw Stock Exchange, GPW, largest in Central and Eastern Europe.
Growing fast.
Growing number of listed companies, record revenue in 2024. Equity turnover jumped significantly, too. It really shows that while, the big Western European exchanges get all the headlines, there's serious activity and growth happening elsewhere in the EU, too.
Absolutely. GPW's strong performance really highlights the potential in those CEE markets. It shows that, the Western exchanges dominate overall size, but there are these significant regional players with their own momentum.
Okay, and finally, you've got Borsa Italiana, now part of Euronext, and FESE, the Federation of European Securities Exchanges, representing, 35 exchanges? Massive combined market cap.
Yeah, huge numbers when you add them all up.
So the key takeaway from looking at all these players seems crystal clear. A few really big fish dominate this pond.
Totally.
And that creates this enormous barrier to entry. Anyone thinking of launching something new would need something really special, right? Like an unaddressed niche or some truly disruptive advantage.
That's precisely the critical insight here. Trying to replicate the scale and scope of these incumbents, it's virtually impossible for a newcomer. Their established liquidity, their networks, their diverse products, it creates this formidable competitive moat, like a castle with really deep defenses,
Yeah.
Very hard for anyone new to breach.
Okay, so against this backdrop of these really powerful incumbents, what about the Capital Markets Union, the CMU? The report brings this up. How does that fit into this whole ambition for a new exchange?
The CMU is a really important piece of this puzzle. Its main goal is creating a single market for capital across the EU. Let investments flow freely.
Right.
The idea is to help everyone, consumers, investors, companies, by making it easier to get finance, especially for SMEs and startups, getting private capital moving and cutting down on all the fragmentation we see in trading and post-trading.
Okay.
FACE, the Exchange Federation, actually supports these CMU goals, cutting red tape, getting more regular people involved in the markets.
That sounds like it should create opportunities for everyone then. A rising tide lifts all boats.
Well, not necessarily for brand new entrants. And this is the crucial insight for our analysis. These unifying forces could, maybe paradoxically, make it harder for newcomers unless they offer something fundamentally different.
Okay. How so?
The challenge is the existing big players are often in the best spot to benefit from CMU's consolidation efforts. Their existing infrastructure, their reach. It means they can integrate and expand more easily as the market gets more unified.
Right. Makes sense.
So for a new exchange to have a shot in this context, it can't just be another generalist place to trade. It needs to pinpoint very specific bits of fragmentation or inefficiency that the big guys aren't really tackling properly. Or it needs to complement the CMU's goals in a really unique way.
Okay, so find a specific angle where the incumbents aren't fully focused. The report then dives into a really interesting bit. This battle over fees, especially market data fees. This sounds like a potential pain point a new exchange could maybe exploit.
Absolutely. There's a lot of, contention around the rising cost and the complexity of market data fees the established exchanges charge. Groups like Market Structure Partners, MSP, they've argued that the majors, Deutsche Börse, Euronext, NASDAQ Nordics, SXX, have seriously hiked these fees. Through things like bundling data you might not need, charging differently for display data versus non-display usage, and even hitting competitors with higher costs. There are definitely allegations that these exchanges are leveraging their dominant position just to boost revenue streams.
Wow. That does sound a bit like they're using their size to, maybe unfairly advantage themselves. The report even gives that example, saying MSP claimed Euronext's market data revenue, as a proportion of total revenue, almost doubled from 2020 to 2023.
Yeah.
Even while the actual value of transactions fell.
Precisely. And while the incumbents, as you'd expect, pushed back hard, Euronext disputed the calculations, said their figure was stable. Deutsche Börse said they don't pass on all costs. NASDAQ claimed increases were below inflation. The core disagreement is still there. It boils down to, what is market data? Is it just a byproduct of trading, something that costs very little to produce? Or is it a valuable service that needs substantial investment to create and maintain? The exchanges argue it's the latter, obviously, and that the fees are needed for investment in keeping markets fair.
This whole fee issue, it really does feel like a significant opportunity for a new entrant, doesn't it? If they could offer market data that's more transparent, simpler, maybe cheaper, that could be a major draw.
It certainly could be a powerful disruptive strategy, though, financially demanding. Think about it. If a new exchange offered much lower or simpler data fees, it could pull in data consumers and maybe order flow too.
Right.
But they need a really robust alternative way to make money because market data is such a big income stream for the established players. The example of Memex in the U.S. is interesting here. They initially offered free data and connectivity.
Right, I remember that.
It shows the potential, yeah. But, the long-term sustainability of that model is still kind of being watched.
Okay, so we've got the big players, the CMU context, this fee battle. Now, let's really dig into the core argument, the actual case for launching a new EU exchange. What are the potential upsides that might make this huge undertaking worthwhile?
Well, your analysis points to several potential benefits. First off, just increased competition. That's a big one.
Right. Keep everyone honest.
Exactly. Put pressure on the incumbents over trading fees and, like we just discussed, those market data costs. Second, innovation. A new exchange isn't stuck with ancient legacy systems. So it has the potential to be much more nimble, introduce new trading mechanisms, new tech, different service models, maybe more flexible, transparent fees.
And then there's the idea of addressing those specific market gaps we touched on earlier, right? This feels like a key area where a newcomer could maybe find a real foothold.
Exactly. The report highlights a few key possibilities. One is SMEs, smaller companies. Now, existing exchanges do have SME-focused markets, Euronext Growth, Access, places like that. But a new entrant could potentially be even more specialized, offer tailored listing rules, maybe cut down compliance burdens, give them better visibility.
But is the demand there?
Well, that's the big question, isn't it? We need to consider if enough SMEs actually want to list on a brand new venue, given the costs and, the option of private capital these days. And also, would investors be keen to trade these potentially less liquid stocks on a new platform?
Okay, what about tech startups? Scale-ups. The report mentions this intriguing idea of a dedicated European tech exchange. Sounds like it could be a real magnet.
That's another interesting possibility, yeah. The goal would be to try and keep European tech talent and innovation in Europe. Because right now, many later-stage tech companies look to the U.S. exchanges, right, for deeper capital pools, maybe higher valuations.
It's true. NASDAQ is the big draw.
Exactly.
Yeah.
Euronext's Tech Leaders segment shows there's a trend this way, but a truly dedicated exchange could really amplify that focus. But again, its success would depend heavily on the maturity and scale of the EU tech scene versus the global pull and liquidity of somewhere like NASDAQ.
And lastly, with the EU pushing so hard on sustainability, could a new exchange specialize in ESG-compliant companies? Green bonds. That feels like a market with real growth potential.
Absolutely. This could definitely attract that growing pool of ethical investors specifically looking for ESG-aligned investments. And the EU's own SME Sustainable Finance Standard shows there's policy support there.
But again, the catch.
The catch is you'd need a critical mass of genuinely green companies ready and willing to list, and a large enough investor base specifically seeking those investments to make sure there's enough liquidity. Can't just be a label.
So the potential upsides are definitely there. More competition, fostering innovation, targeting specific needs, which could ultimately boost investment and align with EU goals.
Right.
But as you said earlier, there's a pretty big reality check when we look at the hurdles. Let's dive into those challenges now. This is where it gets tough.
Yeah, this is where the immense difficulty really hits home.
Yeah.
First, massive hurdle. The regulatory maze. Seriously, we're talking about the sheer complexity of complying with MiFID II, MiFID, METOR, those big European financial market rules. Then there's oversight from ESMA, the European regulator. Then you have variations in national rules, what they call gold plating, where countries add extra layers.
On top of the EU rules.
Exactly, plus the EU Listing Act, and then a whole bunch of others. MAR for market abuse, CSDR for settlement stuff, DORA for IT security. It's costly, incredibly time-consuming. And even with the CMU trying to create a single market, the regulatory landscape is still pretty fragmented in practice.
Sounds incredibly complex and expensive just navigating the red tape. And then there's the actual money needed to even get off the ground. The report breaks this down. Platform development, licensing, cybersecurity, infrastructure, operational costs. The numbers are eye-watering. Millions just to start.
Exactly. Platform development alone, just building the core trading tech, can easily run from, say, $1 million to over 10 million euros. And that's just the basics.
Wow.
Initial licensing and regulatory compliance, if you want to operate across multiple EU countries, could be anywhere from maybe 250K up to over 2 million euros. And then ongoing compliance costs eat up maybe 15-20% of your operational budget every year.
Jeez.
Cybersecurity, huge. Essential investment. Infrastructure, hosting cloud or physical servers, another massive chunk. The report points out that these really high fixed costs create immense pressure to scale up fast.
Which could,
unfortunately, lead to maybe cutting corners on standards or offering unsustainable incentives just to attract that crucial initial trading flow. It's a real risk.
And then there's that classic chicken and egg problem, liquidity.
Ah, yes, the liquidity challenge, the bane of any new marketplace.
Issuers need active trading to make listing worthwhile, right? But investors need listings and activity to create that liquidity. How does a new exchange even start to break that cycle when the incumbents have such deep established liquidity pools?
This is arguably the single biggest hurdle. The incumbents have spent decades building that liquidity, fostering relationships with big institutions, attracting a huge range of listings. IPO markets themselves can be pretty volatile too, so you can't rely on a steady stream of new companies coming to list.
Right.
Plus, a new exchange isn't just competing with other EU venues, it's competing with London, with the US exchanges, which often attract the bigger, more liquid companies. And as the report notes, private capital is a really attractive alternative for many companies now. They might not even need to go public on a new exchange, no matter how innovative it is.
And in a market that's already, well, pretty fragmented, loads of different trading venues across the EU, isn't there a real risk? A new exchange just makes that worse, makes it harder for investors to find the best price and trade efficiently.
That's a critical point.
Yeah.
The EU already has, over 100 regulated markets and nearly 150 MPFs.
Wow, that many.
Yeah. So a new exchange really needs to show it can either attract new trading volume or somehow consolidate existing liquidity effectively. Otherwise, it could just add to the noise, worsen fragmentation, make it harder for investors to find counterparties and get best execution. The European Consolidated Tape Project aims to help with post-trade transparency.
Right, seeing trades after they happen.
Exactly. But its impact on actually encouraging people to trade on new venues before the trade happens, that's still pretty uncertain.
Okay, beyond all the practical financial hurdles, there's also this crucial issue of building market confidence. Trust.
Absolutely fundamental.
People need to trust a new exchange's tech, its rules, its surveillance, its governance. That's something the established players have built over decades.
Precisely.
Yeah.
Trust is just paramount in financial markets. A new exchange has to work incredibly hard to overcome the established reputations and long track records of the big guys. Transparency in everything, fees, rule book, governance is absolutely crucial. Any big operational glitch or even a perceived issue with governance, that could be fatal for a new venture. Just erode that trust instantly.
And of course, all this incredibly ambitious stuff would be happening against a backdrop of, ongoing macroeconomic and geopolitical headwinds, the EU's patchy economic recovery, Brexit fallout, the war in Ukraine, energy crises. You can't ignore the bigger picture.
No, you definitely can't. These broader uncertainties can really dampen investor sentiment, negatively impact IPO activity. It just creates a much tougher environment to launch anything new, let alone something as ambitious and capital intensive as a stock exchange.
Right.
While maybe there's some emerging optimism here and there, things like persistent inflation, central bank policies, trade tensions, that they all pose significant risks. And geopolitical stability is just fundamental for investor confidence.
And the report makes this really interesting point about the interplay between liquidity and those data fees we talked about. It's not enough just to offer cheap data if nobody actually wants to trade there, right?
Exactly. Liquidity attracts liquidity.
Yeah.
It's a fundamental truth. Market makers, active traders, they'll naturally gravitate to where the action is, where there are lots of listings, lots of active investors.
Yeah.
Offering lower data fees might cut their costs, sure, but ultimately that's secondary to the actual trading opportunities and the depth of the market available on that exchange. A new exchange needs a holistic strategy, tackling costs, yes, but more importantly, making the trading environment itself fundamentally attractive.
So the hurdles are, well, they're immense. Undeniably. What kind of key strategic imperatives would be absolutely essential for a new EU exchange to even have a fighting chance of success in this climate?
Your analysis highlights several really critical areas.
Yeah.
First and foremost, an absolutely differentiated value proposition. It cannot just be a copycat.
No Me Too exchanges.
Exactly. It needs to specialize. Maybe laser focus on those underserved areas like SMEs or high growth tech or that burgeoning green finance sector. Or it could offer genuinely innovative market models. Maybe draw inspiration from, say, the LTSE's focus on long-term value, or the UK's PISCZ platform for intermittent trading in private shares.
Interesting.
And as we discussed, radically competitive fees, especially for market data, could be a major differentiator. But again, you need a sustainable revenue model behind that.
And it feels like technology can't just be functional. It has to be a core strategic advantage, like right from day one.
Oh, absolutely. Technology has to enable that differentiated value proposition. Building on modern, scalable, secure tech from the get-go is crucial. Cloud-native architecture gives you flexibility, maybe cost efficiencies.
Well,
They can even explore novel stuff like facilitating trading in tokenized assets or offering really custom order types, using AI and machine learning for better surveillance, smarter risk management, deeper liquidity analytics. That could be a real edge. And of course, low latency connectivity is just table stakes now.
right.
The aim should be to create a fundamentally more efficient, more accessible market, not just marginally faster. DLT for tokenized assets is exciting, sure, but that needs careful regulatory navigation and making sure it works with existing systems.
Then there's the incredibly tough job of actually getting both issuers to list and investors to trade. Can't have one without the other.
Exactly, and that needs really carefully tailored strategies for both sides. For issuers, especially SMEs, maybe drastically simplified listing processes, dedicated support services, investor relations, research coverage.
Yeah, hand-holding almost.
Kind of.
Yeah.
Maybe even things like pilot fishing, lining up cornerstone investors early to show there's initial demand. For bigger, maybe international firms, offering cross-trading facilities could be attractive.
And for investors?
For investors, it's about offering genuinely unique opportunities, ensuring deep, reliable liquidity, competitive costs, high-quality, transparent data, and operating under fair, robust regulation. Targeting specific investor groups and really hammering home the benefits relevant to them, like access to growth capital. If you're focusing on SMEs, that'll be critical.
And how can a new exchange proactively tackle that fundamental liquidity problem beyond just, hoping people show up?
They need to think creatively. Innovative ways to provide liquidity beyond just traditional market makers. Maybe well-designed auction mechanisms, opening, closing, even intraday, exploring conditional orders, regulated dark pools to attract bigger trades, maybe even innovative retail liquidity programs to get individual investors involved. Cross-trading agreements with other exchanges could help bootstrap liquidity early on. And if they're looking at digital assets, maybe compliant versions of DeFi concepts like staking or AMMs. Adapting models like the UK's PISCES for private markets could also be an avenue.
And finally, the report really emphasizes positioning the new exchange within that whole capital markets union framework. It can't just exist in a bubble.
Absolutely not. A new exchange should proactively try to align itself with the EU's big strategic goals. Better SME finance, more retail participation, supporting the green and digital transitions.
So talk to the policymakers.
Definitely. Proactive, constructive engagement with policymakers, both at the EU level and in key national capitals, is crucial. Show how the new exchange can genuinely help build a more competitive, integrated European market. But, as we noted, they've got to balance that policy alignment with making sure they're commercially viable in the long run. It's a tricky balance.
So, after weighing all of this, the opportunities, the massive hurdles, the strategies needed, what's your overall take? What are the prospects for success for a new EU stock exchange? Is it just pie in the sky? Or is there a realistic path, maybe under very specific circumstances?
Well, your analysis concludes that viability is conditional and extremely challenging, let's be honest. Success is most likely for those who can craft an exceptionally strong, truly unique, clearly articulated value proposition, something that solves a real problem or meets a significant unmet need in the European market.
So impact could vary.
Hugely. It could range from pretty marginal, just another small venue, to genuinely transformative. They can disrupt fees, unlock underserved segments, or pioneer truly innovative models. The current EU policy climate offers some openings, maybe, but that big trend of consolidation in the exchange industry, that's a major headwind for any new standalone player.
So not much room for another generalist exchange.
Very little demand for that, I'd say. But real demand might exist for highly targeted, efficient platforms offering credible solutions to specific pain points like SME funding or those high data costs. But it's worth remembering, deep specialization while differentiating also limits your addressable market. Makes it harder to get the scale you need to survive long term.
The report also touches on lessons from recent ventures. Aquist Exchange, MEMEX in the U.S., the long-term stock exchange. What were the key takeaways there?
Yeah, those are useful case studies. Aquist showed that an innovative fee model and good tech can grab market share, definitely. But it also showed how hard it is for an independent Poseidon to keep growing against the giants, hence its acquisition by 6X.
Right.
MEMEX in the U.S. demonstrated that a member-backed model focused radically on cutting costs, remember the free data initially, can attract serious flow. Though replicating that exact model in the more fragmented EU broker landscape might be trickier.
And LTSE.
LTSE illustrated that a strong niche focus, like their long-term value creation angle, is great for differentiation, but it might limit your initial listing uptake if the market isn't quite ready or the niche just isn't big enough yet.
So what's the overall lesson?
I think the overall lesson is that innovation and strong backing, while crucial, are no guarantee. Execution, timing, having deep enough pockets, being adaptable, those are just as, if not more important, and even successful innovators might end up getting acquired. So you either need a really robust independent strategy, or you need to realistically consider acquisition as a potential outcome from the start.
Finally, the report gives some really insightful recommendations, both for potential founders and investors brave enough to try this, and for EU policymakers who want a more dynamic market. What are the absolute highlights there?
For founders and investors, the advice is pretty sharp. Laser focus on real differentiation to solve a big problem. Build a strong consortium, get backing from key market players. Treat technology as a core strategic asset, not just plumbing. Plan a phased rollout. Stay adaptable. Engage with regulators proactively, continuously. Develop a realistic, multi-pronged liquidity strategy. It's not just about being cheaper. Prioritize trust and transparency above all. And maybe pragmatically think about the exit strategy. Acquisition could be it.
Okay. And for the policymakers?
For policymakers, really foster genuine competition in market data. Make sure costs are reasonable, reflect production costs. Streamline and harmonize the regulatory approval for new venues, make it efficient, consistent, cut the gold plating. Actively support niche market development, SMEs, green, tech maybe with incentives, co-investment. Accelerate the CMU implementation, especially post-trade stuff like clearing and settlement. Promote financial literacy, get more retail investors involved. And finally, be ready to monitor and adapt rules for new exchange models, maybe use regulatory sandboxes while carefully balancing consolidation versus competition.
And the final thought?
The final overarching thought is that success here isn't just financial or technical, it's also deeply political and cultural. You need to navigate national preferences, understand established interests, and help foster a broader equity investment culture across the EU. A market-driven approach by a newcomer might really need significant sustained policy support to truly take root and flourish.
This has truly been a deep dive into, wow, a remarkably complex topic. So, to summarize the key insights. Launching a new EU stock exchange is, let's face it, exceptionally difficult given how entrenched the existing players are.
Very tough.
However, genuine opportunities might exist, especially for those who can strategically focus on currently underserved markets, SMEs, maybe green finance, and by directly tackling that whole contentious issue of market data fees with a truly disruptive approach.
Right, those are the potential openings.
But the hurdles navigating regulations, raising huge amounts of capital, attracting liquidity, building trust, they're absolutely immense. Ultimately, any chance of success really hinges on having a highly differentiated value proposition, getting strong backing, leveraging cutting-edge tech for more than just speed, and having a really nuanced, adaptable understanding of both market dynamics and the regulatory maze.
Absolutely. And this really leads to a crucial question for you, the listener, to ponder. Considering the sheer scale and the deep networks of the current European exchanges and the huge amount of capital and regulatory hassle required, what's the most likely path for real market innovation here? Is it going to come from entirely new independent companies bravely trying to carve out a niche? Or is it more likely we'll just see targeted acquisitions, the big established groups buying up smaller, innovative players?
Right.
And if that becomes the main trend, what does it mean for healthy competition and for the overall cost of accessing European capital markets in the long run? That's something really worth thinking about as you reflect on where European capital markets might be heading.